So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha. Welcome back to The Daily Call. Today we're going to answer the question, can options be assigned before expiration? So there's two things we have to cover in this quick little podcast. The first, of course, is the difference between American style and European style option contracts. So really quickly, American style contracts are basically all of the contracts that we generally trade on a regular basis. Those would be your contracts for Apple or Google or Netflix. Many of the ETFs, practically all of the ETFs, are American style. And so what that means is that those option contracts could potentially be assigned before expiration, or you could choose to exercise your contract if you're a long option buyer before expiration. The European style option contracts, which are more of the index style contracts, only assignment can happen or exercise can happen at expiration. So that's the difference. Again, most of the option contracts that you'd be trading on a regular basis are American style, which means that they could be assigned before expiration. Now, the next question is, why would somebody do it? So it's really important that we understand, even though there is a possibility that option contracts can be assigned before expiration, the likelihood of that happening is very, very small. Statistically, most option contracts are closed out of well before expiration, and the ones that do get to the week of expiration, then it's the last couple of days until the last day of expiration in which those contracts are more likely to be assigned or not. It's really a very small percentage of contracts that ever get assigned. Now, the reason that somebody would ever assign a contract, and this is important to know if you are at risk, would only ever be for an option buyer in exchange for getting something else. So people, I don't think, would ever rationally, and so this is not to say they wouldn't do it irrationally here or there, but rationally, nobody's going to assign their long option contract to you as the short option seller unless they're getting something in return for that. Now, one of the ways that they can do that is through dividends, right? So if there's a dividend coming up, they may want to go through that process and collect the dividend. But we talk about all the time in a video update on dividend risk assignment that it has to be in a way that that dividend then covers them to then repurchase a put option and basically get back into the same risk-adjusted position they were in before. So again, there's a lot that moves around here with dividend assignment and option contract assignment, but you have to think, what are they getting in exchange for actually assigning the contracts? The big component that I think about, besides even just that little example of dividend assignment, the big component for me is when somebody assigns a contract as a long option buyer and they assign it to an option seller, they are giving up the extrinsic value of those contracts. So all option contracts have intrinsic value, the value if they were to be assigned and converted to stock right now, and then extrinsic value, which is the time and volatility value. Now, as soon as you go through the assignment process, you give up that extrinsic value. So that's why most of the assignment happens closer to expiration, because there's no or very little extrinsic value left in the contracts. That's why I tell people, even though your contract is deep in the money or could be deep in the money early in the cycle, that does not necessarily mean it's going to be assigned right away. In fact, it probably won't be assigned right away because there's still a lot of extrinsic value in that contract. There's still value in the sense that there's a month or 2 months to go until expiration, and volatility is still priced into the contract. So hopefully this helps out again, just to kind of calm your fears if you are fearful of being assigned. Could it happen? Of course, it could always happen. Does it happen that often? Very rarely. And again, one thing you want to look at is potentially what's left in the contract as far as extrinsic value. Most brokers have the ability to show this on the option pricing chain. You can see the differential between intrinsic and extrinsic value. If there's very little or no extrinsic value, probably are at a higher risk of assignment earlier in the cycle. As always, hopefully this helps out. If you guys have any questions, let me know. Until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.